it's Neil Frankel, Certified Financial Planner. I thought I'd spend a few minutes and give you my insights or my thoughts about what's happening in the markets right now. World markets cascaded down on Monday. I wouldn't say that there was a panic in the streets, but it was frightening. Obviously, one of the catalysts for that steep decline was the Greek government's decision to hold a national vote or referendum on July 5th to approve or reject the EU's offer of more aid in exchange for more austere cuts to their national spending. The government's call for a referendum came after world markets assumed that the Greeks and the EU had agreed to the cuts. So this last-minute surprise really rocked the markets, and that's just what the Greek government wanted. They wanted to threaten Europe with an economic pandemonium in an effort to get more lenient terms from the Europeans, and Europe is calling their bluff. So let's try to get some perspective on what happened, what it means, and what we want to watch going forward. The Greek economy is in a shambles. Greece accounts for about 2% of Europe's GDP. They are to Europe as Detroit is to the United States. When Detroit went bankrupt, it was very hard, mostly for the people who live there, but it wasn't the end for the American economy. And it's reasonable to expect that Europe will survive Greece's financial problems. Keep in mind that the economic recovery in Europe is still very young and strong. Their economy is growing, and their central bank continues to hold interest rates down. Indeed, if you were to look at a chart of the Eurozone markets versus Greek stock market, you'd see that the Eurozone has done very well this year as the Greek market dropped. What I'm saying is that those forces which have helped Europe recover are still in place, a strong economy and low interest rates. But let's talk about Greece for a minute. The government decided to let the people vote on the agreement. There's nothing wrong with that inherently. And while the elected officials are urging a no vote, most Greeks want to stay in the EU and will probably vote yes. Most economists agree that tough times are ahead for Greece either way, no matter what they do. And they will likely endure a painful recession. But if they vote yes, the EU will provide more support, and they can avoid a catastrophe. At the time I'm recording this, more than half of Greek voters understand this and are ready to support the referendum. But there's no guarantee that the yes vote will happen. If the people of Greece reject the referendum, can probably expect more volatility ahead. What's interesting is that the leaders of the EU have already taken precautions to try to head off any domino effect by enhancing its central bank's ability to maneuver in the capital markets. And that's a really good thing, and it might help contain the volatility. If the Greek financial crisis really threatened the EU economy, you'd probably see interest rates rise dramatically across Europe. But that hasn't happened. They remain very low. We've seen a little bit bump up, but not much. And this is another stabilizing point. They've gone up a bit, but it hasn't been extreme. In my opinion, the Greek surprise was the catalyst, but not the entire reason for the sell-off on Monday, especially here at home. Our markets have been strong for a long time, and corrections happen. I don't know if we're in a correction now or not, but I am not taking any chances. I believe it's time to be strategically conservative right now. And what that means is that funds that are doing relatively well will be held. But if there are funds that are not doing well, I'll likely sell those, and I'll only replace them with new funds when the overall market shows some strength. Of course, I'll keep you posted as we go forward. Let me know if I can answer any questions. I wish you a good week, and happy July 4th weekend coming up. Thanks.